Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel. It's Wednesday, March the 5th. Welcome to our Global Markets Commentary. A North American trade war is here. Tariffs are a negative for the entire North American economy. They risk increasing inflation and lowering economic growth. Or maybe it's not here. Very confusing headlines continue to emanate from the U.S. administration. Capital markets enter this shock from a position of strength. The TSX Composite and the S&P 500 were making fresh highs earlier in 2025 as the macroeconomic and corporate earnings growth backdrop is pretty good. In fact, corporate earnings growth across a broad swath of global equity markets are surprising to the upside, including the US and Canada. From earlier this year market peaks to the market close on March the 4th, Canadian stocks had melted about 5%, and the S&P 500 was down about 6%. It's good to see capital markets taking note and correctly pricing these as negatives. This capital market reaction is an important feedback loop for the U.S. administration. Decision makers will use it to calibrate the magnitude and speed of implementing their agenda. We don't want to minimize the impact of tariffs on the Canadian economy or even Canadian stocks. Indeed, the ongoing uncertainty of tariffs has been dampening business investment. However, we sense people are jumping to conclusions and expressing a level of fear that we'd like to address. To begin, let's talk about the tariffs themselves. Remember, we are talking tariffs, not sanctions or embargoes. Cross-border business activity will not fall to zero. It's also noteworthy that the tariffs are focused on goods, while the North American economy is heavily tilted toward a service-based economy, including trade in this category. Although tariffs are a negative, several factors should be considered. First, tariff policies may be initially or eventually, given negative ramifications, more item or sector targeted than this opening salvo. Second, the exchange rate is an important shock absorber for the economic impacts of tariffs. The loonie is down 8% from September 2024. Third, American consumers will likely eat some of the tariffs when they buy from Canadian businesses that have competitive advantages and/or significant market share. Businesses subject to a greater degree of U.S. domestic competition, however, will bear more of the brunt of tariffs. If the tariffs last, we can expect a Canadian fiscal and monetary policy response. That will help Canadian businesses and households weather the storm. And it may be just a storm. We don't know if the tariffs will stick. A backlash from U.S. capital markets, business leaders, and voters could spur a rethink. These are the best chances to see these ill-advised policies reduced or reversed. We do think mounting negative blowback will eventually generate so much pressure that the president will see the merit of taking one of the off-ramps available and still claim a victory. We know from experience that there can be lots of room for negotiation. Lastly, the tariff threat has some silver linings for Canadians. The national outpouring of Canadian patriotism is heartwarming, something we knew was always inside of us, but maybe not so near the surface. These emotions are a wake-up call to examine how we do business in this country. It is motivating conversations around pipelines and resource policy, trade relationships, interprovincial trade, taxation, and fiscal policy, pointing them in constructive directions. This external threat is changing the narrative on measures designed to drive economic growth, investment, and productivity. We have an opportunity to strengthen Canada as a place to invest, work, and live. As always, maintaining a well-diversified portfolio across asset classes, sectors, and individual issuers is the best defense against these bouts of market volatility. Those are our thoughts on the current situation. Thank you for joining us. We look forward to you tuning in next month.